All right, so a couple of days ago, I uploaded my 10K a month trading strategy and it got over 20K views. And what I explained in that video was that on the daily time frame, whenever a swing low or a swing high is formed, you can consider the high or the low of the third candle as your easiest draw on liquidity, right? So basically, when a swing low forms on the daily, right, you're marking out the high of the third candle, and on the next day you mark out the opening price of that daily candle. You look for a manipulation that sweeps some form of liquidity on the 5-minute time frame, and then you take your entry and target the high of this third candle. Now, what if I told you that instead of looking at it on the daily, you can look at it at every single time frame, because price is fractal. And similarly, let me just invert the chart. So whenever a swing high was formed on the daily, you would mark out the low of the third candle, and then you would wait for the opening of the next candle. So let's assume that this is the opening, right? You would wait for accumulation. Basically, accumulation is not necessary, but you would look for some form of liquidity sweep above the opening price, right? On the 5-minute time frame. Then you would look for a market structure shift, then take your entry and target this low. And similarly, you would look for a liquidity sweep below the opening price when you were targeting the high of this third candle. Now, you can do the same thing on every single time frame. And for this model, you can use the 15-minute time frame. So on the 15-minute time frame during London and New York session, you are basically identifying swing lows and swing highs, right? Now, there is like 80% chance, above 80% chance that whenever a swing low is formed, the high of the third candle is going to be taken out by the next candle. And similarly, whenever a swing high forms on the 15-minute time frame, there's 80% or above chance that the low of the third candle is going to be taken out by the next candle, or the other candle that forms after the fourth candle. As long as this low is not breached before your entry, right? Or this low is not breached before your entry, the setup will remain valid. So on the 15, you mark out, right? You identify the swing low. So let's assume that we identified a swing low on the 15-minute. Now you mark out the opening price, the high of the third candle, which is right here. Now the next 15-minute candle, when it opens, you mark out the opening price of that candle. So this line over here is the opening price, and this line here is a liquidity on the 1-minute time frame. So once you mark out the opening price of the 15-minute candle, drop down to 1-minute time frame. Now look for liquidity sweep below the opening price on the 1-minute time frame. So there's going to be liquidity, right? Now, once price sweeps a liquidity on the 1-minute time frame, you are looking for inverse fair value gap formation or a market structure shift, right? And once you do that, you're taking your entry on the retest. Or if you get a market structure shift, you're taking your entry from that fair value gap. Now, you are simply targeting the high over here. Very, very simple, guys. It's basically accumulation, manipulation, and then distribution to take out the high of the third candle. Similarly, if you identify a swing high on the 15-minute time frame, what you would do is wait for the next 15-minute candle to open, mark out the opening price, and then drop down to 1-minute time frame. Now you look for a liquidity sweep above the opening price on the 1-minute time frame. So once you get the liquidity sweep on the 1-minute, you look for a 1-minute inverse fair value gap formation or a market structure shift. Now, once you do that, once you get that, you're taking your entry on the retest of the inverse fair value gap, or you're taking your entry off the fair value gap if you got a market structure shift. And you are simply targeting this low around here. Very simple. And as I said before, you must identify these swing highs and lows during London and New York session. And if a swing high or a swing low is formed after some key liquidity was taken out, or it forms in some higher time frame PD array, it makes it even higher probability. But it can work wherever it forms, so don't worry about it. So let me give you guys some examples and then I will end the video. All right, so before moving on to the actual examples, I want to show you guys how it would look like without, dropping down to 1 minute time frame. So you can see that we have a swing high over here, 1, 2, 3, and the low of the third candle was taken out after 1 minute power of 3. It went into premium or it swept some liquidity. But then you can see that we have a swing low here, 1, 2, 3. This candle is the lowest. And the high of the third candle, as you can see, was taken out. Now 1, 2, 3, this is the lowest. The high of the third candle was taken out. Then we have a swing high over here, but in this case it was not taken out, so that would have been a losing trade if we got like a market structure shift on the 1 minute or an inverse Fibonacci gap. But you can see that we got a swing low formation here, and the high of the third candle was taken out. Now if you look at it here, we have a swing high, so this is the highest candle, and if you mark out the low of the third candle, you can see that it was taken out. Now if you see that we have a swing low here, so 1, 2, 3, this is the lowest, and the high of the third candle was taken out. Now if I look at it like this, you can see we have a swing high, 1, 2, 3, and the low of the third candle was taken out. Now if you look at this here, we have a swing low and the high of the third candle was taken out. Then we have a swing high over here, 1, 2, 3. The low of the third candle was taken out. And then we have a swing low here, 1, 2, 3. This is the lowest. The high of the third candle, as you can see, was taken out. And then we have a swing high formation once again. And you can see that this is the third candle and it was taken out. And that was the end of the day. So now let me show you how I would take my entries. All right, everybody. So now I'm going to show you how I would actually take my trade. So you can see that we have a swing high formation and this is the low of the third candle. Now what I will do is look at this green candle. This is like the new 15-minute candle. So once it opens, you have to mark out the opening price. Now once you do that, you could drop down to 1 minute time from here, and what you can see is we are above the opening price, and that is very important. Now we have swept this high, then we have swept these highs, right? And now I'm looking for a market structure shift with a fair value gap, and you can also see we swept, okay, never mind, we swept this high over here. So over here I have like a confirmation that price wants to go down. Body closure is not necessary when we are on the 1 minute because that time is too fast, so it doesn't matter. Then we have this fair value gap, so that would have been my entry level. I would put my stop right above this high, and I would take profit at this low here, giving me 2.3 RR. So if I play this through, you're gonna see that the take profit level was hit. Let's move on to another example. All right, so here is another example. So we have a swing high here, and I'm going to mark out the low of the third candle, right, of the swing high. And this is the new candle that opens, so I'm going to mark out the opening price. Now I'm going to drop down to 1 minute, and I'm looking for a liquidity sweep above the opening price. So this is the opening price. We have swept this liquidity over here and this high over here. Now you can see that we have an inverse fair value gap formed after price took out liquidity. So once the candle closed, this old fair value gap became inverse fair value gap. And then you would simply take your entry on the retest, put your stop right above this high. Oops, I think I would put it here. And your take profit would be this, giving you 2.73 risk to reward. So if I play this through, you can see price went up. But then eventually, after some time, the take profit level was hit. So this could be like your bread and butter model that you can use every single day. There are tons of setups that form every single day. Please make sure you take like the best possible setups. Don't just go crazy because that's going to affect your psychology. Go for 1 or 2 setups max per day. As with any other strategy, you would do the same. So yeah, guys, that is it for this video. Usually I upload on Sundays, but I thought I should like stop gatekeeping this technique and give it away to my subscribers for absolutely free. Please subscribe. That's all I want from you guys. Anyways, I'll see you guys on the Sunday. Goodbye.